Welcome to Module 2 of Mastering Candlestick Patterns. In Lesson 1 of this module, we'll unravel the mysteries of the Doji candlestick pattern. The Doji represents indecision in the market. The Doji is not as significant if the market is not clearly trending, as non-trending markets are inherently indicative of indecision. If the Doji forms in an uptrend or downtrend, this is normally seen as significant, as it is a signal that the buyers are losing conviction when formed in an uptrend and a signal that sellers are losing conviction if seen in a downtrend. Hence, Doji patterns are ideally used as reversal patterns after an uptrend or downtrend. The Doji, often considered the crossroads of the market, holds valuable insights for traders and investors. So, what exactly is a Doji? A Doji forms when the opening and closing prices of an asset are nearly identical, resulting in a thin, horizontal line. This pattern suggests that neither the bulls nor the bears have a clear upper hand during the specified time period. But what does this mean for your trading decisions? Well, the significance of a Doji lies in its context. In an uptrend, a Doji could indicate potential weakening momentum, while in a downtrend, it might signal a potential reversal. It's important to note that Dojis come in various forms, each with its own interpretation. The standard Doji signals market indecision. The long-legged Doji suggests extreme uncertainty. The Dragonfly Doji and Gravestone Doji hint at possible reversals. Understanding the context and type of Doji is key to making informed trading decisions. So, as you embark on your journey into the world of candlestick patterns, remember that the Doji is your guide at the crossroads. Get ready to explore more candlestick patterns in the following lessons of Module 2. Thank you for watching.